What I'm kind of focused on is what happens after the debt ceiling, because if they do successfully raise it, the Treasury's already depleted their cash balance. They're nearly at zero. They don't really have any spare cash anymore, and so they have to go back to the debt market like they normally used to and issue more bonds in order to keep paying their bills. And they also want to refill their cash balance back up to their $500 billion target, which basically means pulling liquidity out of the market, kind of like what the Fed's doing. And so the challenge there is if they do that too quickly, or they do it with a lot of longer duration bonds, they risk pulling that liquidity out of the banking sector.
U.S. President Joe Biden has signed a bill into law suspending the country's debt limit, ensuring the avoidance of a default. The bipartisan budget agreement, in effect until January 2025, halts all debt ceiling talks. President Biden's announcement emphasized the reduction of the deficit, protection of social programs, and the commitment to veterans. However, financial analyst Lyn Alden advises caution, as the agreement means both the Treasury Department and the Federal Reserve will be withdrawing liquidity from the economy, potentially leading to a liquidity crisis. Alden discusses her predictions in a recent interview, highlighting the need to monitor market stability amid changing liquidity dynamics. The debt ceiling agreement comes as a relief, preventing the United States from experiencing its first-ever default. President Biden's bipartisan budget agreement, signed into law, suspends debt ceiling discussions until January 2025. The focus now shifts towards building a robust economy while reducing the deficit and safeguarding social programs. However, financial analyst Lyn Alden warns of potential challenges ahead, as the Treasury Department and the Federal Reserve will both withdraw liquidity from the economy, possibly triggering a liquidity crisis. Alden discusses her predictions in a recent interview, emphasizing the importance of monitoring market stability amidst the changing liquidity landscape. President Biden's signing of the bill suspending the debt limit ensures that the United States avoids a default. The bipartisan budget agreement, effective until January 2025, puts a halt to debt ceiling talks, providing relief for the nation. The president's announcement highlights the commitment to reducing the deficit and safeguarding social programs and veterans' benefits. Nevertheless, financial analyst Lyn Alden advises caution, as the agreement means both the Treasury Department and the Federal Reserve will withdraw liquidity from the economy, potentially leading to a liquidity crisis. Alden shares her insights in a recent interview, stressing the need to closely monitor market stability amidst the evolving liquidity environment.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
The debt ceiling has been something I've been following ever since they technically ran into the debt ceiling back in January, right? So we've actually been in this multi-month period of the Treasury doing extraordinary measures to, manage their cash. And so back then, my key theme was that liquidity is actually probably going to be pretty good for the next several months, because the Treasury was forced to basically push their cash into the market because they had to spend down their cash balance in order to keep paying their bills, because they couldn't finance it with new debt, and they didn't, and their taxes don't cover it. And so for the for pretty much the first half of this year, the debt ceiling has ironically probably been constructive for markets, because the Federal Reserve has been tightening this whole time, and the Treasury's basically been forced to offset that. So you've had a neutral liquidity environment. So I was like, a lot of things are probably going to go sideways. Some things could go up, and so I wasn't too concerned with markets in general. So it was a somewhat bullish thing. But the point that I've been kind of concerned about for a while is that when the debt ceiling is actually resolved, ironically, the liquidity environment could change. And of course, this is based on what a handful of policymakers decide to do, but it's something we have to navigate. What I'm kind of focused on is what happens after the debt ceiling, because if they do successfully raise it, the Treasury's already depleted their cash balance. They're nearly at zero. They don't really have any spare cash anymore, and so they have to go back to the debt market like they normally used to and issue more bonds in order to keep paying their bills. And they also want to refill their cash balance back up to their $500 billion target, which basically means pulling liquidity out of the market, kind of like what the Fed's doing. And so the challenge there is if they do that too quickly, or they do it with a lot of longer duration bonds, they risk pulling that liquidity out of the banking sector, and they risk causing another round of bank liquidity problems, failures, messy Treasury auctions, messy Treasury market, illiquid Treasury market in general. I think that's kind of the key risk. And also just negative liquidity environments are bad for most risk assets most of the time. or at least it's one of the big variables that affects kind of the multi-month performance of major asset classes. So part of the reason why the first half of 2022 was so bad for most asset prices was that liquidity was constantly going down because the Fed was no longer adding liquidity to the market, and back then the Treasury was refilling its cash account from roughly zero after the prior debt ceiling issue. And so that was a particularly bad combination for liquidity, and we could repeat that again, but it's going to come down to what a handful of policymakers decide to do. How quickly do they want to fill that? What duration do they want to fill that? Are they going to be able to pull it out of reverse repos, which would be somewhat liquidity neutral, or are they going to end up kind of messing it up and pulling it out of banks and causing a round of problems? So you could see that. You could also see kind of forced QE while still trying to hold rates tight. One of the dynamics that we saw back in 2019 was the repo spike. And back then, you basically had a flood of T-bills come to market, and there wasn't really a lot of excess bank reserves to kind of pull that out. And so you started to get dysfunctions between bank lending. And so the Federal Reserve had to abruptly stop their quantitative tightening and go to doing quantitative easing, although they didn't want to call it that because they were only doing with T-bills, and they were only doing it for financial stability rather than as an intended form of stimulus. So the reasons for it and the specifics were a little bit different, but basically they kind of lost control of their balance sheet temporarily due to actions by just overall liquidity and Treasury decisions. This one would be a little bit different because it's not that there's too many T bills; it's that there might be too many T notes and T bonds relative to cash to absorb it, relative to the money wants to stay in money markets, and so I think you could see a similar dynamic. It's also kind of what happened back in March with the first round of bank problems, is that the Fed didn't want to provide that liquidity, but they were kind of forced to temporarily. They had to open up this new facility and use a bunch of existing facilities to put at least temporary liquidity back into the market. And so you could see the Fed's hand forced if they were to break something seriously, like if the Treasury market gets dysfunctional, if you have another round of bank failures, if some of those kind of key markets freeze up again.
When asked about the projected timeline for the liquidity crisis, Alden anticipates it to be relatively short-lived, coinciding with the period in which the Treasury refills the Treasury general account. However, despite its brevity, the crisis's impact is expected to have a lasting effect. Alden points to the regional banking crisis in March as an example, which lasted only weeks but resulted in significant banking collapses and surpassed the magnitude of the 2008 financial crisis. The resurgence of such a crisis, triggered by the double quantitative tightening measures from the Federal Reserve and Treasury, could lead to even greater collapses. In the interview, Alden delves into timelines, strategies to navigate the impending storm, and reveals her preferred long-term asset. Alden predicts that the liquidity crisis will be relatively short-lived, coinciding with the period during which the Treasury replenishes the Treasury general account. However, despite its brevity, the crisis is expected to have enduring repercussions. She cites the regional banking crisis in March as an illustration, which lasted only a few weeks but resulted in significant collapses exceeding the 2008 financial crisis in terms of impacted banks and assets involved. The potential resurgence of such a crisis, fueled by the double quantitative tightening by the Federal Reserve and Treasury, could lead to even more substantial collapses. In the interview, Alden shares insights on timelines, strategies to navigate the impending storm, and her preferred long-term asset. When discussing the projected timeline for the liquidity crisis, Alden suggests that it will be relatively short, aligning with the period of Treasury refilling the Treasury general account. Nonetheless, the crisis's impact is expected to extend beyond its duration. Alden points to the recent regional banking crisis in March, which lasted only a few weeks but caused significant collapses, surpassing the magnitude of the 2008 financial crisis and involving more affected banks. The looming risk of a similar crisis, driven by the simultaneous quantitative tightening actions of the Federal Reserve and Treasury, could lead to even more substantial collapses. In the interview, Alden delves into timelines, strategies to navigate the approaching storm, and her preferred long-term asset.
I think this is mostly a 6 to 12 month story because this is specifically trying to refill the Treasury account from an unusually low level, which really only it gets down to this level due to debt ceiling issues. And we're also kind of skipping along kind of the minimum amount of liquidity that the banks can have. We kind of ran into that level back in March around the bank, crisis, specifically the small and medium banks were kind of at their liquidity limit, and they got refilled a little bit because these temporary Fed actions. But if we do another environment where the Treasury is now sucking liquidity back out, the Fed's still doing quantitative tightening, we could retest those liquidity limits and kind of get another round of this. So when we look longer term, it's different types of fundamentals that I would look towards, but liquidity is what I look towards when I'm trying to figure out what's going to happen in 3, 6, 12 months, or at least it's a big factor that I consider among some others.
What type of moves do you make?
So this would be primarily cash equivalents. So I've been using what I consider I call a 3-pillar portfolio, which is kind of a different framework than the 60-40. So basically, one pillar is cash equivalents. It could be money markets, T-bills, cash in the bank, that kind of thing. Another pillar is just long-term equities, generally profitable long-term compounding equities. Could be indices, could be individual stocks. And then the third pillar is commodity plays, hard assets, infrastructure, hard monies, gold, Bitcoin, things like that are more debasement hedges or inflation hedges, decent amount of energy exposure, for example. And each of those pillars defends or benefits from a certain type of environment. And so should we get these, the kind of the worst case scenario liquidity problems, that's where the cash equivalents would really come in handy for, reducing some downside volatility and allowing for a rebalancing opportunity into some of the other more attractive long-term assets. So basically, I manage the risk just by not being fully invested at all times.
Basically, if I put you, your friends or family, yourself, whoever you want to go with on an island for 10 years, and you could take one investment, throw your phone in the ocean and ignore about it. It could be the index, it could be a commodity, it could be whatever you want. Something where you feel, next 10 years, this is somewhere I really believe in to invest in.
Probably Bitcoin. It's probably a decent way to finish it. I think it benefits. I think the network effect and the overall technology is still not understood, and I think it's still strengthening. I think as other things happen, as AI makes certain things cheaper, any sort of scarce asset is attractive, and something that should hold its value long term. And then, like I said, it's basically just I think in many ways it's the future of money, and so it's something that while you can never be 100% sure about, I think it's probably my number one investment theme.
We'd like to hear your thoughts on the matter. If you had to choose a single asset to preserve your investment for the next 10 years, which one would you prefer? Would it be Bitcoin, other top cryptocurrencies, or an entirely different asset class? Please share your responses and reasons in the comments section below. Additionally, we are keen to know your opinions on Lyn Alden's interview and her predictions regarding the forthcoming liquidity crisis. Feel free to drop your comments and observations in the comments section as well. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.